Joining us right now to talk more about the markets is JoAnne Feeney, partner and portfolio manager at Advisors Capital Management. JoAnne, you think that this is a situation where, things are looking a little better. I think you also think that the banking crisis has been resolved, at least at this point.
Well, good morning, Becky. Not entirely resolved, but certainly moving in the right direction as far as investors understand it. That doesn't mean that there aren't certain banks out there which still have some balance sheet problems. So we'll be watching for that. Now, clearly, the inflation numbers are encouraging. Things are moving in the right direction. However, we still have some pretty substantial underlying services inflation in particular. So I think investors should not expect the Fed to ease off its rate hikes anytime soon. At the same time, with inflation moving in the right direction and the Fed committed to getting it under control, I think investors are looking beyond the next few meetings to the recognition that eventually rates will be cut, and that becomes a tailwind. This is one of the reasons I think why we've seen those tech stocks rally so much here at the beginning of the year.
Yeah, okay, so let's talk about that. I mean, the expectation from most people we talked to recently has been that, yeah, the Fed will continue to raise a little bit. That's not something that would make sense from these markets, but you just say they're looking beyond that. You think rate cuts are coming this year, or you think it's something that gets pushed out to next year and beyond?
Yeah, hard to tell. Obviously, it'll depend on the data, whether inflation continues to slow, whether the super core inflation measure starts to slow down. So we're not anticipating rate cuts this year. But, still, investors look beyond that. You look a year out from now, and I think we'll be in an era of rates being cut. But the other thing in technology, right, is these companies are seeing now the end of the PC decline, the smartphone sales decline. We're seeing inventory start to clear. And that's another reason I think why these have rallied. Plus, the slowdown in cloud spending now looks like it's going to be over soon. And so you have both sort of that multi-year driver for the tech companies of cloud and internet and the generative AI pushing NVIDIA and others. And so that looks like an area of the economy with significant growth outpacing other sectors. And so I think it's been some recovery since those names came down all last year.
Well,
we're
that's
still
what I
not
was going
back.
to say. We're not back all the way, but given the big gains we've seen in those stocks, you still like them, even with that positive storyline?
You have to be really selective, Becky. I mean, we do like AMD, NVIDIA, Broadcom, which is a broader supplier into that space. We do expect that there could be a little bit of a stall here and further appreciation, which is appropriate. We think investors are going to make sure they're diversified because recession risk has not gone away. And we think there's going to be sort of, a realization that investors also need to put some protection in their portfolios. Whether it's a company like a Target or a TJ Maxx, also look to summer. Consumers are going to be traveling more as they have been. Look to a name like Casey General Stores. They're going to be out on those highways. They're going to be stopping in at those convenience stores. So there are other places one could go to diversify their portfolios because we do think it's going to be a volatile year as rate expectations fluctuate and as recession expectations fluctuate.
JoAnne, just talking about that, would you even consider things beyond stocks just because of where yields have gone to this point? Would you mix things up a little bit more?
Yeah, well, the balance strategy that I run also, gives our clients an opportunity to choose for themselves the mix they want of fixed and equity. And with fixed yields, as you say, Becky, as high as they are, that offers a lot of protection against inflation. It's certainly a good conservative place to go if you are sure that you need your cash flow now rather than later. But if you're a long-term investor and you have time to wait out the volatility that we're likely to continue to see in stocks, we don't see a reason to change that allocation because ultimately, bond coupons are going to kind of keep up with inflation, but they're not really going to get you ahead over the long term.